Hey everyone, have you ever wondered why different countries have different currency values? You've probably noticed that when you exchange your home currency for a foreign currency, you get a different amount back depending on what currency you're exchanging with. For example, if you were to exchange 100 US dollars to British pounds, you would get 80 pounds. But if you were to exchange 100 US dollars to Japanese yen, you would get 10,000 yen. So why is it that some currencies are stronger than others? There are many factors that influence the value of a currency, but they can be boiled down into a few key categories. The first category is the strength of a country's economy. Generally speaking, the stronger a country's economy, the stronger its currency. There are a few ways to measure the strength of an economy. One common way is to look at a country's gross domestic product, or GDP. GDP is the total value of a country's output of goods and services. Second category is the country's interest rates. Interest rates are the percentage rates that banks charge for loans. Higher interest rates tend to attract foreign investment, which increases demand for the currency. A country's inflation rate is the third factor in determining the value of its currency. Inflation is the rate at which prices for goods and services increase over time. Generally, higher inflation leads to a weaker currency. That's because when inflation is high, it means that a country's economy is growing very quickly. While this is generally a good thing, it can lead to a decrease in the value of the currency. Country's balance of trade is fourth factor impacting the currency value. A country's balance of trade is the difference between the value of its exports and imports. When a country exports more than it imports, it has a positive trade balance, which tends to strengthen its currency. Conversely, when a country imports more than it exports, it has a negative trade balance, which tends to weaken its currency. Last but not the least, countries' political stability and economic growth has long-lasting impact on currency value. Investors tend to favor currencies of countries with stable governments and strong economies. So when a country has these two things, its currency tends to be stronger. Let's dive into some real-world examples of currency values. Right now, the euro used by 19 European countries is worth about 110 US cents. So 1 euro equals 110 cents. Pretty cool, right? The euro stands for unity and stability among these nations, making it one of the strongest currencies out there. On the other hand, the Sri Lankan rupee is struggling, reflecting the country's economic challenges. It's a wild world of currencies, and these differences tell a big story. So the next time you re-in another country and you see that their money is different from yours, just remember it's not just because they like to have different bills and coins, it's because their economy is different from yours. If you enjoyed this video, please give it a thumbs up and share it with your friends. Subscribe to our channel for more videos like this. Thanks for watching. That's all for now. See you next time.